All right. Today is Tuesday, April 13th, and this is a recap for the stock market activities today. Remember this? The two different routes that the market is debating taking. Route number one involves higher yields, with the reopening inflationary and value stocks outperforming. And then we have route number two with lower yields and tech, stay-at-home, and growth stocks outperforming. One of these themes will be the predominant theme for the market in 2021. One of these themes will outperform the other. For the market to make the decision on which route to take, it has to debate the three main dynamics dictating the market right now. Number one, the virus. Number two, inflation. Number three, treasury yields. These are connected. If we are able to defeat the virus and reopen sooner and more globally, at least from an expectations perspective, that unlocks the door for inflation to rise higher. And if inflation rises higher, treasury yields rise higher. And if treasury yields rise higher, the Federal Reserve will get ever closer to tapering monetary policy. And the market does not want that outcome, because tapering monetary policy will mean the party is over. So far, the expectations were that we are making significant progress in vaccination and in reopening plans. And therefore, the door for inflation was wide open, and inflation expectations continued to rise higher and higher and higher, and therefore pushing treasury yields also higher and higher, and therefore the expectations for tapering also rising, expecting tapering sooner than the Federal Reserve saying it would. And what the market does every day is processing the news and every piece of data and asking the question, do I have enough information to unlock the door for inflation to rise higher? If that is the case, do I have enough information to unlock the door for treasury yields to rise higher? What news did we get today in the morning? Number one, the halting of Johnson & Johnson's vaccine due to the blood clotting issue. Right away, you are shooting the first and most important door, the door that unlocks every other door in this dynamic. The virus. If we are tampering the vaccination progress expectations, then we are in turn shutting the door closed for inflation expectations to rise higher. Furthermore, just to illustrate for you the importance of this piece of news regarding Johnson & Johnson's vaccine. Yesterday, we heard from St. Louis Fed President James Bullard. And James Bullard said that we should expect tapering from the Federal Reserve if we reach 75% vaccination rate in this country. In essence, Mr. Bullard is tying tapering to vaccination progress. The piece of news we got in the morning throws cold water on the vaccination progress, and therefore also pushing the expectations of the upcoming tapering from the Federal Reserve further away than previous expectations. And the take here that perhaps, yes, we have enough doses from the Pfizer or Moderna vaccines to pretty much vaccinate every single American. The news of halting Johnson & Johnson's vaccine due to blood clotting issues will scare certain people away from getting their vaccination, and therefore it will take us a lot longer to reach the 75% vaccination threshold that James Bullard was talking about yesterday. And therefore, the market is saying there is no upcoming tapering. The tapering got pushed a little further away. The market rejoiced, and you saw a massive orgasm in the market, specifically in the names related to technology, growth, and high multiple names, because these are the names that thrive under low rates environment. Of course, all of that happened on the heels of the 60 Minutes interview on Sunday by Chairman Jerome Powell. And Chairman Powell said that the Federal Reserve does not expect tapering anytime soon. So now you combine these statements from Jerome Powell and James Bullard, you process the news from Johnson & Johnson, and you come up to the conclusion that the tapering is further away than we previously expected. At least this is what the market said today. This is not me saying it, by the way. I do have a totally different take, but this is what the market decided today. And then the next important thing we received in the morning is the core inflation data, the CPI, aka the CPI. And the CPI number showed massive increase in inflation. But here's the catch. It was only a hair above economists' expectations, meaning that they cooked the number good enough to show inflation, not to hide it, but with just a razor-thin margin over expectations. And therefore, the market processed all of this data and said, well, you know what? The first door is closed, therefore, inflation expectations go down. And since the number came just a razor thin above expectations, that's not good enough to negate the first piece of news, the Johnson & Johnson vaccine news. And therefore, you saw the Dow Jones struggling, the inflationary trade, the reopening trade, and what was in favor, the stay-at-home trade, and the high multiple stocks, aka the mania names. Now, the media was confused in the morning about what to make from the market's move. And here is a headline from CNBC calling inflation tame inflation. The truth, however, is that the number did not show tame inflation. This is the CPI we're talking about, and it is showing a massive surge in inflation. If the CPI is showing a massive surge in inflation, then actual inflation is much, much larger. We will go over all the facts during the headlines of the day segment. But here is yet another headline to illustrate the confusion from the media and the deflationary crowd. Remember what they used to say. Yes, commodity prices are rising higher. Yes, treasury yields risen higher, but gold prices are going down, and therefore the risk is actually deflationary. And I told you that is bullshit, and the deflationary camp are a confused bunch because gold hasn't been correlated with inflation since the 80s. It actually has an inverse relationship with inflation expectations, specifically the 10-year treasury yield. So if inflation expectations were dampened today by the news from Johnson & Johnson and the quote-unquote tamed CPI number, why didn't gold trade lower today? It actually traded higher. Inverse relationship with the 10-year treasury yield. Inverse relationship with inflation expectations. I hope that the myth is gone right now. This gold myth that the deflationary crowd continues to tout. Anyhow, we have a big discussion here, so let's not waste any more time and get to covering the market. And here we go. The Dow Industrial Average closing in the red, down 68.13 points, or a decline of 0.20%. The Nasdaq leading the day, closing in the green by 146.10 points, or a gain of 1.05%. The S&P 500 closing in the green by 13.60 points, or a gain of 0.33%. And what about the sector's performance for the day? Leading the pack at number 1 and capturing the gold medal, technology. At number 2 for the silver, utilities. At number 3 for the bronze, consumer cyclicals. The laggards of the day led by financials, industrials, and defensives. The theme could not be any clearer today. The deflationary trade of technology, utilities, and consumer cyclicals, we're talking about Amazon here, is outperforming. Meanwhile, the inflationary trade of financials, industrials, defensives, energy, materials underperforming. The $1 million question is, how long will the negative impact from the CPI number we got today on inflation expectations last? Because when we shift to the coverage of futures, the prices of commodities are actually continuing to climb higher, meaning that this so-called dampening of inflation expectations is perhaps temporary until and unless we see a meaningful pullback in commodity prices. Crude oil actually closing in the green today, with the WTI closing with gains over 0.5 percentage point. Meanwhile, Brent closing the day with over 1% gains. Likewise, when we talk about softs futures, lumber, any give back? Absolutely not. Up again today, about 2% or so. Likewise, we saw gains for cotton, coffee, cocoa, and sugar futures. Even OJ futures closing slightly in the green. Meanwhile, tamed activities for metals. Metals, as if they're saying, we're not sure what to make of today's move. We're not buying the stock market move, and we are not buying the move in the bonds market either. So that is one thing to watch here. Metals futures reaction, specifically tomorrow. And remember, gold is a very important canary in the coal mine, and gold will let us know if this reaction we saw in the market today is sustainable or not? What about meats futures? Pullbacks for feeder and live cattle futures. Meanwhile, lean hogs futures flat for the session. What about grains? The only laggard, soybean meal futures. Meanwhile, we saw massive gains for soybean oil, corn, soybeans, canola, oats, wheat futures, all closing with sizable gains today. Rough rice futures remain muted. Once again, commodity prices are not confirming the move we saw in the equities market today. Moving on to the big casino, the options market, and we've been talking about the absence of retail traders. The casino has been awfully quiet, and we're not seeing the participation of call options gambling, the call options mania, as we saw last year. So that begs the question, where is the retail trader? Today we received more information confirming the absence of retail traders. The call options volume in the stock market has declined significantly since the recent correction, specifically in the mania names. And perhaps Jim Cramer of CNBC has a good explanation to what happened to retail traders.
Why is it that equity volumes are falling so dramatically, and is that a warning sign as we're at these new highs?
Well, I think that candidly, I think that the new kind of buyer that we were talking about, the Robinhood strong buyer, the Merriman, I think they kind of got blown out. A lot of them got blown out because they concentrated on a couple of stocks. They concentrated on, when you look at Wall Street Bets, it really just decided that they were going to focus on AMC, at GameStop, and somewhat Palantir. Kathy Wood, the red-hot mutual fund, ETF manager, not that great performance. And then a lot of them get caught up in what I say is the high flyers. And we use Snowflake as an example. They just kind of got into these stocks and didn't know what they really own. Now, all of what I just said is going to cause tremendous opprobrium against me.
But perhaps there are signs of life here, because today we saw slightly elevated volume in certain names, starting with Apple closing at number 1 with about 1.8 million contracts. About 77% of those were calls. At number 2, Tesla with about 1 million contract. About 63% of those were calls, pretty much doubling the volume from yesterday and opening a wide gap between the put to call ratio, because about 60% of the total volume traded for Tesla options today was for calls. What about number 3, Palantir, with over 600,000 contracts, almost doubling the volume from yesterday? And check out this number. Over 87% of the options volume traded for Palantir today was for calls. Massive surge in call options buying for these particular names, Tesla and Palantir. Both were successful in creating a mini gamma squeeze, and both names closed the day with sizable gains. What about the unusual trades that took place in the options market today? Starting with the ticker IHRT. This is for iHeartRadio. And in the previous video, we covered a trade for this particular name. Somebody's making a bullish call. And today we saw what happened with this stock. The stock finished the day up double digits, and they are betting for more gains to come. By buying the 22.5 calls expiration date, May 21st, with expectations that the name will gain over 7% by then, they paid about 80 cents a piece to enter this trade. All in all, bringing the total to about $700,000. What about the ticker TSLA for Tesla? Massive gains today and yesterday, but somebody's calling for a pullback here by buying the 715 puts expiration date this upcoming Friday, April 16th, with expectations that Tesla will pull back over 6% by then. They paid about $3.40 a piece to enter this trade, bringing the total all the way to $2.8 million. What about the ticker ZM for Zoom? The moment we got the news about the Johnson & Johnson vaccine, right away you saw the stay-at-home stocks, namely Zoom, Peloton, and DocuSign, outperforming today. And right away we saw a massive surge in call options buying for Zoom. They're not betting that this is a sustainable move that we saw in the market today. They're not betting for the revival of the stay-at-home trade once again, but they are betting that this trade could heat up in the next few days due to short covering gamma squeezes from the Johnson & Johnson vaccine news. And in this case, they're making a bullish bet by buying the 360 calls expiration date this upcoming Friday, with expectations that the name will climb over 5% by then. They paid about $1.40 a piece to enter this trade. All in all, bringing the total to about $1 million. What about the trade for the ticker Plan? This is a software company and we have a spread trade here. It is a bullish bet, a debit spread buying the 67.5 calls expiration date May 21st, with expectations that the name will climb over 6.5% by then. They paid about $2.70 a piece to enter this trade. At the same time, they sold the 77.5 calls expiration date also May 21st, and they are expecting the name to rise over 6.5%, but not over 22% by then. And they collected about 90 cents a piece from opening this leg. All in all, the total entry cost for this trade was $1.80 a piece, which brought the total all the way to about $1 million. What about the trade for the ticker WDA? This is for Workday. They're making a bearish bet here by buying the 240 puts expiration date May 21st, with expectations that the name will decline over 10% by then. And they paid about $3 a piece to enter this trade. All in all, bringing the total to about $1.6 million. What about the trade for the ticker NVDA, Nvidia? Here was a bullish bet by buying the 700 calls expiration date May 14th, with expectations that the name will climb over 12% by then. They paid about $6 a piece to enter this trade, which brought the total all the way to $3 million. We do have news of Nvidia entering the CPU market, competing directly with Intel. Next, we have the ticker SNAP, Snapchat. They're making a bullish bet by buying the 68 calls expiration date April 30th, with expectations that the name will climb over 8% by then. They paid about $2.70 a piece to enter this trade. All in all, bringing the total to about $1.3 million. What about the trade for the ticker NIO? They're making a bearish bet here by buying the 35 puts expiration date May 28th, with expectations that the name will decline over 8.5% by then. They paid about $2 a piece to enter this trade, bringing the total all the way to $1 million. Moving on to the headlines that shaped the day, starting with macro news. What else? The core inflation number. And the number was cooked, but not too many onions. Meaning, we're going to show inflation, but we're not going to show that much. We're just going to make it exceed expectations by a little notch. And that should be good enough to tamper inflation expectations, at least temporarily. Because here is the headline. U.S. Consumer Prices Index rose the most in nearly 9 years in March by 0.6%, as massive fiscal stimulus unleashed pent-up demand. And here it is. This is the largest gain since August of 2012. And the number is building up on the gains from last month of about 0.4%. A 9.1 surge in gasoline prices accounted for nearly half of the increase in the CPI. Gasoline prices rose 6.4% in February. Food prices edged up 0.1%. Does anybody believe this garbage? The cost of food consumed at and away from home also rose 0.1%. Economists, polled by Reuters, had forecast the CPI advancing 0.5%. We got 0.6%. Just a tiny bit above. That's the cooking right there. In the 12 months through March, the CPI surged 2.6%. That was the largest gain since August of 2018 and followed a 1.7% increase in February. And here is how we know that the CPI number is hiding the true picture of inflation, and therefore we call it the CPI. Here is the relationship between money supply and inflation, and the relationship is very clear. Very, very strong correlation going all the way to the 1800s. And here we have the largest and most rapid increase in money supply ever. But somehow the CPI and core inflation is not shooting higher. What's going on here? Is the 100 years plus correlation over? Or do we have games being played here, specifically in the kitchen? Here's yet another indicator showing that the CPI number cannot be believed. because the correlation between the U.S. cyclical/defensive ratio year over year is in very strong correlation with the CPI number. We have a shot higher in the cyclical defensives ratio, but somehow the CPI this time around decided to just sit there and not follow the correlation that goes back for at least 20 years. And here it is. The Consumer Price Index is not economic reality. Indeed, it is fiction. The nation's leading indicator of inflation has always existed as a creature of politics and power, revised and updated in ways that betray its image, aka the numbers are being cooked. Because the number is showing quote-unquote tamed inflation. Where is inflation? Where is this inflation everybody's talking about? Is it here? Is it there? Is it maybe somewhere over there? Here is inflation. You can choose to continue to deny all you want, but the facts don't lie. And I got the facts for you. A below the radar data point in the Labor Department's Producers Price Index shows the sharpest monthly spike in the price input materials used by businesses since 1974. Oh gee, I wonder what happened back in the 70s. The cost of U.S. processed goods and materials rises the most in almost 47 years. But hey, where is inflation? Is it over here? Is it over there? Where is it? Can't see inflation. What about lumber prices? You know, real inflation, not the CPI. Lumber futures have surged more than 60% to record highs this year. Soaring wood costs have already added more than $24,000 to the price of the average new U.S. house, according to the National Association of Home Builders. So next time your wife or your girlfriend ask you for wood, you better tell her to start paying for that. Oh, wood is so expensive these days. Matter of fact, here it is. Lumber future prices by year. So far, the year 2021, year to date, it is the largest increase in lumber prices in history. But hey, where is inflation? And that is of course impacting home prices. Housing market still on fire. Ratio of sale to list prices has spiked well above 100%. The annual price growth reached 17% in March, the highest data going back to 2012. And what about food prices? Because the CPLI says that food prices rose 0.1%. Here is the truth. World food prices continue to soar as they hit a nearly 7-year high, reports the FAO. What about shipping costs? Shipping costs remain highly elevated, and they're almost triple the prices of last year. But hey, where is inflation? I can't see inflation. Papa Jerome says there is no inflation, and if there is inflation, it will be transitory. And if it's not transitory, Papa Jerome says he got the tools. I trust Papa Jerome, but perhaps you're saying that lumber prices and food prices, that's the exception. But everything else is going down. Prices of everything else are going down. How about we talk about lithium, since we're talking about the EV mania, and we're pushing EV stocks higher and higher by the day. Here it is. The US is facing lithium-ion battery shortage as electric vehicle production ramps up. So the input cost for vehicles is rising higher. In addition, here's the double whammy. What about rubber prices? The world's rubber supply is stretching thin, leaving auto suppliers scrambling to avoid yet another supply chain fiasco. Rubber prices surging higher. And the results? Here it is. Used car prices soar, and the sticker shock may get even worse. And therefore I told you to buy CarMax stock. And CarMax had a massive dip 2 weeks ago, and the stock already recovered all of the losses from 2 weeks ago. This trade remains extremely hot because used car prices will continue to surge higher. The cost of used vehicles has soared since the end of last year, and prices are likely to stay high for a while. In the past 12 months, used vehicle prices have jumped almost 10% to mark the biggest increase in more than a decade, according to the U.S. Consumer Price Index published on Tuesday. But hey, where is inflation? Is it here? Is it there? There's just not as many used vehicles for sale. For one thing, the pandemic forced rental agencies to slash purchases of new cars after a steep decline in individuals leasing cars at airports and other locations. Those vehicles typically are sold to used car lots after a year or less. The recent fiscal stimulus, highlighted by the $1,400 checks for most Americans, has also given customers more money to spend. Yet they should be prepared for sticker shock for used vehicles. Edmunds estimated the average cost of used car or truck now tops $20,000. And of course, this is benefactory to the so-called inflationary trade. Not today, but if inflation continues to rise, it will eventually maul its way through all the bullshit and the deception coming out of the Federal Reserve and the Bureau of Labor Statistics. Raw materials prices have surged. Corporate profits are likely next. Higher input costs generally accompany broad economic growth, allowing companies to pass along added expenses and fatten margins. These are the inflationary names. Companies including Levi Strauss, Constellation Brands, and Conagra Brands, the packaged food company behind Vlastik Pickles and Ready Whip, have told investors they're pushing prices higher in response to more costly raw materials. However, there is a point where the system will not tolerate increases, but we are not in one of those places today at all. Things are lined up where this should be a pretty good party. Why is it a good party? Because the consumer is currently flush with cash, the stimmy, the high savings rate, and they could absorb the increase in costs. But after that's exhausted, we could be paving the way for the phenomena of stagflation. Because here it is, family income no longer tracks economic output. The per capita GDP all the way to the 80s has been primarily driven by median family income growth, not since then. And now we have opened the widest gap in decades between the per capita GDP and the median family income growth. And on top of that, your taxes are gonna go higher. But hey, let's shake it off for now. Taylor Swift. Because the budget gap rose to $660 billion. This is for March, by the way. 1 month, as the government issued a third round of stimulus checks to help Americans ride out the economic fallout from the pandemic. How the hell are we gonna pay for that? And I know what you're gonna say, the printing machine. The printing machine will continue to do that until inflation gets out of hand. And by the way, the bond market will speak way sooner, and the Federal Reserve will quote-unquote let you know ahead of advance of any upcoming tapering. Meaning the move in the market will happen before Jerome even think about telling you about it, because he will tell his Wall Street buddies first, they will act, and then you'll know about it later. The current budget deficit is trending to be the largest budget deficit in history. But the geniuses over at Wall Street and the business news media keep saying that, oh, Joe Biden is not going to raise taxes this year. We can't raise taxes as long as we are still recovering from this horrible pandemic that affected us all negatively. Just take a look at our savings rate. Whoops. Lastly, in macro news, what about the tensions between the United States and China? One of the components of the wall of worry. China is increasingly warning Washington not to challenge a mission it views as sacred, the eventual reunification with Taiwan. China been violating Taiwan's airspace day after day after day. They are planning for the annexation of Taiwan and reunifying Taiwan with China. But hey, who cares, right? World War III, shake it off. For all we know, bad news is actually good news for the stock market. Have you noticed that pattern? Good news is the worst news for the stock market. We don't want any good news. We want doom and gloom, wars, pandemics, death, destruction, because that's good for the stock market. I told you, market bulls are cheering. COVID, COVID, COVID. And today they got their wish. Moving on to market sentiment news. What about the current stock market mania? What's going on in the bubble? Stock bulls bet it all on earnings guesses with troubled record. So market participants are going all in, assuming that corporate earnings will be fantastic and stocks will continue to surge higher and higher and higher. Good entry point to the market, bro, right? Wrong. Here it is. Corporate profit margins, the S&P 500, earnings before interest and taxes as a percentage of revenue hasn't grown at all. And matter of fact, it is actually lower than last year. But somehow stocks continue to march higher and higher and higher. And that is due to the inflows for more and more and more market participants. Is it really a good entry point, bro? When the forward, not the regular, the forward PE ratio is pretty much trending at the same levels of the dot-com peak. Meanwhile, the S&P 500 earnings yield is trending lower. But hey, good entry point, bro. What about the percentage of stocks trading above the 200 days moving average in the S&P 500? The reading is pretty much at all-time highs. The majority of the S&P 500 stocks are already above their 200 days moving average. And that usually precedes very large corrections in the stock market. Once again, good entry point, bro. How about this one? The cyclically adjusted price to earnings ratio from Robert Chiller, the CAP-E. The current trend that started last year is the steepest trend in history since the CAP-E was adapted. But hey, good entry point, bro, right? To the moon. What else we have to shake off? Here it is. Biden's tax hike proposals will deal a severe blow to corporate earnings growth next year, Goldman Sachs strategists warn. But are market participants even listening? Of course not. So we got inflation spiking higher all over the place. We have a market at all-time highs valuations across a variety of metrics, and we have upcoming threats to earnings from higher taxations. But keep telling me that I'm perma-bear and I'm just being too negative and I'm not seeing the half-full side of the glass. These are facts. Are they facts or are they not? The La La Land market continues to ignore every single sign of an upcoming disaster. You want to go ahead and dance until the music stops? Go ahead, because of course all of you geniuses will get the timing exactly right. You'll get out of the market just before the music stops. You'll know exactly how to spot that. Nope, the market will give you the illusion that everything is safe. It's going to make all-time highs day after day after day, and then out of the blue, boom. So what are you saying here, Maverick? Are you saying we should hide under a rock and wait for the crash? No, I'm saying use your head. Avoid the mania, avoid the crowd's favorite, and stick to good, solid balance sheets with good valuations, because those are the stocks that will continue to dance even after the music stops. That's all what I'm saying. More in market sentiment. Of course, we have the most insane valuations ever in the stock market, but these so-called perma bulls, they're not actually perma bulls, they're perma pigs. They're creatures of the bubble, just like we saw back in the dot-com bubble. Everybody's a genius amidst the bubble when everything is going higher. Everybody's a genius. We have certain names that live forever. They're the highlight of the bubble. They make the biggest gains. They become the hottest names during the bubble. And when the music stops, the house of cards come down collapsing on these specific people. And the number one face of this current bubble we're in is Cathie Wood of ARK Invest. And when asked by Reverend Elon Musk himself, who is concerned about current valuations in the market, Cathie Wood came up with a bullshit answer trying to justify that current valuations are actually cheap. And she's saying, oh, I went all the way back to the 1800s and early 1900s, and the market today is way cheaper than it was before the disruption revolution. Perhaps Cathie Wood forgot to do her homework, but I did it for her. So here are the facts. The stock market capitalization in advanced economies. We are at the highest readings ever. And this is, by the way, the median reading, the highest reading in history, going all the way back to the 1800s. We have surpassed the financial crisis highs and the dot-com highs. Furthermore, to expose the bullshit from Tesla witch Cathie Wood, the Hussman margin adjusted PE ratio, which is one of the most respected, reliable indicators throughout the history of the stock market. The indicator shows the highest reading in history, going all the way back to the year 1900. We have surpassed the financial crisis highs, we have surpassed the dot-com bubble highs, and we have surpassed the reading preceding the 1929 crash. We are, ladies and gentlemen, at the most overvalued stock market ever. The biggest bubble, the biggest mania of them all. We are living in history. And what about the 21st century's tulip mania? Nearly 3 out of 4 professional investors in Bank of America survey see Bitcoin as a bubble. And here we have more. The US is behind the curve, quote unquote, on crypto regulations, says SEC Commissioner Pierce. So the SEC is coming for Bitcoin. Furthermore, the Federal Reserve and the Treasury Department are coming for cryptos. The Biden administration is stepping up scrutiny of China's plan for a digital yuan, with some officials concerned the move could kick off a long-term bid to topple the dollar as the world's dominant reserve currency. And here is Jerome Powell, the chairman of the Federal Reserve, said the central bank is involved in a large-scale research and development project on the digital dollar. And we have billionaires, the likes of Peter Thiel, speaking against Bitcoin, calling it a Chinese weapon to devalue the United States dollar and make it irrelevant. Now, these billionaires might be investing in Bitcoin, but that is just a small fraction of their total wealth. Their wealth is tied up with the US dollar, and therefore they will rush and support any effort to protect the US dollar from declining, even if it means going against cryptocurrencies. More in sentiment news. With all of the facts that I'm showing you tonight, the geniuses over at Wall Street continue to snort coke and issue more insane price targets. Tesla will surge 58% from current levels with improved battery supply set to drive an $8 billion energy business, Canaccord says. So now the souffle is an energy company. Where are the robo-taxis? Can we talk about that? Buy Tesla because it could be the next Apple. Here is how. And you don't have to read the article because they bring out the bullshit argument of robo-taxis. Tesla will never be the Apple of anything. Apple sells a phone. That's a necessity. And the entry price for the Apple ecosystem is the price of the phone, about $1,000 or so. Tesla produces cars, EV cars, not a necessity, number one. Number two, the entry cost is north of $30,000 and will continue to increase higher and higher and higher with the rise of commodity prices, including cobalt, nickel, lithium, etc. And this is why the comparison between Tesla and Apple is a false one. Tesla will never be the Apple of anything. Apple operates in pretty much a duopoly. Tesla operates in what's going to be a very, very competitive market. And speaking of the souffle, let's segue to corporate-specific news, starting with Tesla. Tesla's burning its solar roof customers with a huge price increase. Here we go. With the prices of raw materials rising higher, the margins of Tesla will continue to get squeezed higher and higher and higher. That's option number one, because remember, the company barely makes profits, absent of selling regulatory credits. So either the increase of raw materials prices, input prices, will squeeze their margins, or they have to pass that extra cost to the end customer. Doing that in the EV wars will put Tesla at a disadvantage because NIO and other Chinese competitors will be able to underprice Tesla. But hey, the robo-taxis, bro. And Tesla is a monopoly, right? Wrong. Here comes the competition. If you haven't noticed already, watch out Tesla. This new Mercedes-Benz could be a game changer, says Douche Bank. The EQS is set to launch on Thursday, not 2 years from now, not the false hopes and dreams by Reverend Elon Musk. Thursday, and douchebag analysts led by Tim Rokosa believe the car will likely set the benchmark in terms of technical features, as well as design and quality across battery electric vehicles. German engineering, baby, here it is. It's coming for the souffle. We have beautiful pictures for the new car. Of course, they're not revealing the entire body of the car, but it looks futuristic and simplistic at the same time. If that wasn't enough, here's more pain coming for the souffle. Chinese telecom giant Huawei plans on a $1 billion bet on electric autonomous cars. A Huawei executive said at an event in China that the telecom's autonomous driving technology has already surpassed Tesla's in some areas, such as self-driving for more than 600 miles without human intervention. Remember that Tesla's quote-unquote autonomous vehicles cannot even drive in the loop underneath the Vegas Convention Center. But somehow they're going to compete with this. Oh, but bro, you're wrong. Tesla's up 8% today, 10% tomorrow. It's up today and tomorrow because of Bitcoin. So did MicroStrategy. And tomorrow we have the Coinbase IPO. If that is not a bust and Bitcoin explodes higher, yes, Tesla will trade higher. But is this a solid investment theory? A company whose price action is tied to the most volatile investment vehicle ever? Think again. And what about Apple? Apple is facing expensive delays to its new MacBook Pro. And the reason is the chip shortage. But continue to put your blindfold on and buy. We see Apple surging higher every single day for the last 2 weeks due to institutional investors buying Apple with clients' money. But here the company's saying, whoa, we might have shortages here due to the situation with chips. But I guess that's a shake it off too. And here is more from Apple. Apple is building a new Apple TV, an actual TV, not an app, with built-in camera and speaker. Moving on to Boeing, aka the flying coffin. Boeing finds potential electrical issues on some of its 737 MAX planes and alerted customers that they should ground the jets. Can the flying coffin do anything right? Anything at all? And what about Alibaba? And since we did not produce a show last night, we missed covering the news from Alibaba. Here's what happened over the weekend. China slaps Alibaba with $2.8 billion fine in an anti-monopoly probe. And you would think that news like this will crash the stock, but the stock actually rallied almost 10% on the heels of this news. Why is that? Here it is. How a $2.8 billion fine added $40 billion to Alibaba's valuation. Alibaba investors are relieved that the only thing they have to deal with is a huge fine that could yet prove optimistic. Jack Ma's fortune jumps $2 billion after record Alibaba fine. And the point here is that investors were pricing something more ominous and more severe as a form of punishment from the CCP against Alibaba. But now we are talking about a mere $2.6 billion fine, which is nothing to Alibaba, and therefore investors rejoiced. Jack Ma's Ant Group bows to Beijing with company's overhaul. This is the second reason of why the stock surged higher. Perhaps the worst episode between Alibaba and the CCP is behind us. And here we have the greatest investor of all time, Charlie Munger, and he revealed that he has a stake in Alibaba worth $37 million. Moving on. You know, if you are holding the bag in Beyond Meat and you are itching to hold another bag, I got good news for you. Because here it is. Impossible Foods is preparing for a public listing that could value the U.S. plant-based burger maker at around $10 billion or more. Good entry price, bro. But perhaps you don't like the fake meat IPO and you're looking for something more genuine. I got something for you. A new IPO, new tickers. Jessica Alba's Honest Company files for an IPO, looking to go public on the NASDAQ under the symbol. Here's the ticker. You got your notes ready? HNST. Jessica Alba. Optimism to the moon, bro. What about Domino's Pizza? Domino's starts making autonomous pizza deliveries. The robots are coming for your job. Whether you are working at Amazon warehouse or delivering pizzas for Papa John's, or Domino's Pizza, the robots are coming for you. But hey, the minimum wage and unionization, we don't want to do that because then they're going to replace us with robots. Well, I got bad news for you. They're going to replace you with robots anyways. So you might want to juice these pricks on your way out. What about Nvidia? Video game graphics chip maker Nvidia to start making CPUs, sparking competition with Intel. As if Intel needed another jab, another uppercut, here comes Nvidia. What about Microsoft? Microsoft is reportedly close to buying speech tech giant Nuance. You saw the stock surging higher yesterday. Now, the price is a little steep, and it is a reminder, reminiscent of the dot-com bubble highs, where we saw massive price tags for acquisitions with no regards whatsoever because everybody thought that they will be flushed with cash. They pay $16 billion to buy a small company. Who cares? Because the retail mania will push the stock and create that $16 billion next week. The party goes on until it doesn't. And can we please stop this trend already? The Peloton of roaring an interview with Hydro CEO. So now we have an at-home rowing machine, an at-home mirror that costs you $5,000. So you can have some asshole in your mirror shouting and yelling at you, trying to encourage you to make that last set of push-ups. You know, I went online and I bought a mirror, a very large mirror, for $20. And I have my laptop on YouTube and I exercise watching YouTube videos. Do I really need a $5,000 mirror with an asshole in it to start working out? And you know what? After all of that, you are still fat. Speaking of fat, what about Kim Kardashian? Here it is. Kim Kardashian's shapewear brand, Skims, is now valued at $1.6 billion. Even as shoppers shifted to looser fitting clothes during lockdowns. Kim Kardashian, the future bro. Moving on to the heat map analysis. Right away, you can tell that the breadth of the market was not that good. We have two giant names with massive gains, Apple and Tesla. Single-handedly, these two names contributed to the Nasdaq surging higher. We have Google, Facebook, Amazon muted for the day. Microsoft, noticeable gains of about 1% or so. Yet all in all, Apple and Tesla were the biggest contributors to today's rally in the Nasdaq. And today, with inflation expectations being tampered, we saw the mania names making a comeback. For example, Palantir closing with gains of about 9% today, Square 3%, Nvidia 3%, software names surging higher. In addition, since we now have concerns regarding the vaccines, we saw the stay-at-home stocks also catching a bid today, specifically Zoom with gains over 6.5%, Peloton with gains of almost 3%, and DocuSign with gains of almost 5%. The inflationary trade, a pullback in financials, and we have earnings regarding financials, and this is a typical behavior for financials pre-earnings. Yet we saw a pullback in the inflationary trade in industrials, defensives, and even certain areas in materials. Meanwhile, energy remained stable. But today was a deflationary day. The deflationary trade had the upper hand today, and that could not be more evident than the performance of, say, IBM, Oracle, Cisco, Micron, the quote-unquote value names within the technology sector, underperforming today when they were outperforming when we had higher inflation expectations in the market. The question is, how long before we start resuming pushing inflation expectations higher, given the fact that commodity prices are not pulling down? Moving on to the themes analysis. What about the stay-at-home names? Overall, a negative picture, but not by much. You're not seeing that mass exodus from the reopening names, which tells you that the action we saw today is temporary. The concerns regarding the Johnson & Johnson vaccine are temporary because the facts are we do have enough vaccines from Pfizer and Moderna. What about the inflationary trade? Once again, a negative picture overall, but not by much. There is no mass exodus from the inflationary trade toward the deflationary trade, meaning a rotation of the rotation that started last year. Speaking of, remember this? For my old subscribers and viewers, last year when we were tracking the rotation from the stay-at-home stocks, the momentum names into small cap and reopening names. Today, the stay-at-home names managed to outperform the reopening names for obvious reasons. Furthermore, what about the deflationary trade? Outperforming specifically the mania names, the high multiple names. Tesla, DocuSign, that is probably an error here. It should be positive, 4.76. Square, Shopify, Okta, Zoom, all closing with massive gains in the green. Moving on to the technical analysis, starting with 30 minutes chart of the SPY, the SPY. What's going on here? Nothing new. We continue this low volume grind higher, although the SPY managed to struggle just a little bit in the morning when the market was searching for direction. Moving on to the daily chart of the continuous contract of the SPY, the S&P 500, breaking out all-time highs. We do have the gap highlighted in the yellow circle, and we've been talking about gaps recently, and I have a few questions. Are gaps important? How do we determine if a certain gap is important? You have to study the chart. The chart has reliable patterns from the past. Certain charts Most charts, for that matter, don't like opening gaps. 99% of gaps are closed. Now, certain charts are gappy in nature, and you cannot apply the same rules to those charts. Not among these charts is the SPY futures, because by nature this is a continuous contract and it shouldn't be leaving gaps higher or lower. And the question now is, we are at all-time highs. So how do we search for the next resistance? When we have a chart marching at all-time highs, the sky is the limit. So you have to look at the RSI indicator and study from which level did the chart pull back in the near past. And when we do that, we are overbought, meaning we are overheated and we are ready for a pullback because we are surpassing the level of about 70, which happens to be the level that the chart prefers to pull back from, at least from the activities going back all the way to last year. So we are expecting a pullback in the SPY. Could it be due to the Coinbase IPO? We have to sell certain things to buy the Coinbase IPO. Could it be tomorrow's bank's earnings? It doesn't matter, but the SPY is ready for a pullback. Moving on to the Qs, 15 minutes chart. Once again, gapping higher, we are in the series of higher highs and bull flag formations. The center of gravity remains 323, meaning if we are going to correct this move at some point, we are going back to 323. We have a few gaps to fill, we can go back and forth, but in a meaningful correction of the recent move higher, we should go back to 323. Now the chart is on a breakout, pretty much trading at all-time highs. You cannot make a solid conclusion looking at the 30 minutes chart. So we have to look at different charts here, starting with the continuous contract of the Nasdaq daily perspective. We talked about the importance of 13,900 and that the chart should not blast higher above that level without facing meaningful resistance. Today, we spent about 5 minutes with 13,900. As you can see from the 15 minutes chart, we struggled just a little bit, catching support and then closing above that level. All-time highs. Here's another way to look at this chart, the daily chart of the continuous contract of the Nasdaq. We had an inverse ABC pattern that played to the downside. You can look at it as a head and shoulder or ABC patterns. An inverse ABC pattern followed by an ABC pattern. The question is, did we just complete the C pattern, the C leg, and we are done? At what level do we expect the Nasdaq futures to pull back? Well, you are at all-time highs. You don't have any level to look forward to. So what do? You look at the RSI. From which level did we pull back in the recent past? And the answer is very close to where we are right now, in or around the level of 70. So once again, we are expecting a pullback here in the Nasdaq. And what about the IWM 30 minutes chart? Unlike the SPY and the Qs, the IWM continues to underperform. For now, we don't have any solid conclusion whatsoever from the 30 minutes perspective. We do have a gap. We could go all the way down to 218, close the gap, and retest 218 for support. But switching to the daily perspective, specifically for the rut, it's not looking so good. You have the negative divergence. You have the head and shoulder formation. You're closing below 2,264. You are struggling to cross in the MACD indicator and creating green impressions in the histogram, showing a lot of weakness here for small caps. The question is, what will it take to start the next impulsive move? There is a massive move coming in the Russell 2000. My bet is to the downside, not to the upside. The Russell 2000 represents the reopening trade, the mania names of GameStop, etc. Now that we're seeing some tampering of inflation expectations, perhaps you could see pullbacks in the reopening names, additional pullbacks in airlines, cruises, hotels, casinos, and that should pull the IWM and the Russell 2000 lower. And what about the dollar index? Breaking below 92, the bullish trend remains intact so long that the chart is making higher highs and higher lows. For now, we are not breaking the trend, but it is starting to look a little weaker here. We talked about the currency in circulation on Sunday, and that the expectations are that the chart will break below 92. And indeed, this is exactly what the chart did. Now, what about gold? Gold rising higher, but not decisively. Gold is the mature guy in the room. It doesn't like to make a decisive move, an impulsive move one way or the other, without confirmations. Now, remember, gold has two enemies, the US dollar and yields. Both of those were down today, so why couldn't gold finish above 1750, 1750? Every tailwind was in favor of gold today, and that did not happen. Is gold trying to send a message about today's activities? I'll leave that answer to you. What about Bitcoin? We were wondering if we are making a lower high. That is not the case. I told you there is a massive move coming in Bitcoin. If I am betting to the upside, specifically going all the way to 68,000. We are already trading at 63,000. We could go all the way to 68,000 by tomorrow. And BTC managed to print a decisive crossing in the MACD and creating great impressions, signaling that the positive momentum is just starting. We have a positive crossing in the RSI correcting the negative divergence. BTC could not be any bullish than this. The $1 million question though is, will the Coinbase IPO bomb? Will it be a bust? Will we see sell the news phenomena? If that is the case, bye-bye to the rally in Bitcoin. Once again, if I'm betting that the Coinbase IPO will be successful and we will see Bitcoin prices surging higher. There has to be something here. Either the absence with retail traders is much worse than we expected and the IPO bombs tomorrow. Other than that, the expectations are that the IPO will be successful. Moving on to yields. What's going on here? So long as the series of higher highs and higher lows remains intact, the trajectory for yields is higher. We are struggling here in yields. We have the support of 1.6%. If that is broken and we start creating lower lows, then we are going all the way back to 1.5. Now, yields pulling back all the way to 1.5 will be extremely beneficial to the mania names. You will see a sizable recovery in names like NEO, Plug Power, Palantir, Solar names. Even some of the stay-at-home names will start to recover. ARK, etc. So if you are bearish on these names, you better hope that yields will rebound by tomorrow from the levels of 1.6%. And what about the TLT, Fibonacci perspective? We are still consolidating here, building up for the next move up or down. And the thresholds are 139, closing above 139 from a daily perspective will mean much higher prices for the TLT. But closing below 134.5 by the end of the week will mean going all the way back to at least 128 in the TLT. So watch 139, that's the immediate one, and then by the end of the week, 134.5. What about the VIX? The VIX remains stable here. And if the VIX goes down from an RSI perspective all the way to the reading of 35.7, I will be buying the VIX with both hands. This is one reliable level in the RSI from which the VIX continues to rebound higher. Moving on to Apple, what's going on here? 30 minutes perspective. Yesterday, we went down to 131. Retesting 131, the center of gravity right now, not once, but twice. Successful retesting and launching higher, creating a bull flag followed by another bull flag. For now, the formation in Apple is bullish, and we have closed the gap at 131.19. What about the daily picture? Can we spot an upcoming pullback? If we use the Fibonacci retracement levels, we're kind of close here to 134.5, which should be a resistance level for Apple. Apple could pass that, it could trade all the way to 135, 136, but you see the consolidation in the blue level in the Fibonacci retracement levels, that will be a very sticky point to blast above, meaning that the best case scenario for Apple right now is a consolidation around the level of 135, meaning that if you did indeed buy calls last week, 2 weeks ago in Apple, you should be booking profits at this level. And finally, what about Tesla, the souffle? What's going on here? Massive day for the souffle. But remember this, during the weekend, we discussed 4 scenarios: 2 bullish, and 2 bearish. One of the bullish scenarios was a bull flag consolidation. And I told you if that breaks out, we will go all the way to close the gap at 781.30. And the point of presenting you with these scenarios is that you're going to know right away from yesterday's action on Monday. If you reviewed the scenarios and you looked at the chart, you would have come up with the conclusion that we are seeing the bull flag scenario. And you would have known right away which level you should be looking at as the next destination. In this case, 781.30. And here's what happened. The bull flag is playing out. We are getting very close to the target of 781.30. The chart currently at resistance from one of the Fibonacci retracement levels. Specifically, the level of 700 and 603. Now, it doesn't matter if the chart faces resistance, so long as it goes all the way and closes the gap at 781.30. But if we pull back before closing the gap, 781.30, if we see a closing below 700, 603, meaning a failure to reach the final destination of closing the gap, then that will be a solid reversal signal, and I will be loading on puts once again. Moving on to the conclusion of this video. What do we have on the economic calendar for tomorrow? Big day, lots of macro data. Some might be very impactful, by the way, regarding inflation. We have the initial jobless claims, retail sales, the Philly Manufacturing Index, and the Empire State Manufacturing Index. These will be extremely important, and if they come out at historical highs, then you combine the data from the PPI, the CPI, and you will come up to the conclusion, in addition to commodity prices, that inflation expectations should be surging higher. Treasury yields should be trading higher. The only obstacle right now is this Johnson & Johnson vaccine. However, I am not buying that the market is taking the pullout of Johnson & Johnson's vaccine as a serious concern, meaning if tomorrow's macro data come out also supporting higher inflation, it is just a matter of time before we resume pushing yields higher once again. The next thing to watch out for is banks' earnings. We have JP Morgan, Goldman Sachs, and Wells Fargo tomorrow, with massive implications for the XLF and the financial sector. Now, usually, banks pull back before earnings and then they pop after earnings. However, these names been on a tear. JP Morgan, Goldman Sachs, Wells Fargo since the beginning of the year. So the risk is to the downside. If earnings don't come out excellent and the guidance isn't pumped higher and we see a pullback, an additional pullback in yields, we could see a lot of pain in the financial sector tomorrow. And therefore, my playbook is I only own 2 names here. Goldman Sachs and US Bank. So I did buy puts for both names, but I'm also using the volatility and elevated premiums to raise some cash. And I am selling puts for Morgan Stanley, JP Morgan, and Bank of America. Once again, out of the money puts to raise cash. And I don't mind if one of these names pull all the way down to reach the strike price, and I am obligated to buy the stock, because the long-term trajectory for these names is higher. So this is the playbook and my strategy for banks' earnings this week. And don't forget, we will have videos during the weekend covering earnings per usual. And lastly, the most important thing to watch out for tomorrow is the big IPO, Coinbase, which is expected to trade at a higher valuation than the entire New York Stock Exchange market. Full-blown mania, but once again, this is one of the hottest IPOs of the year. Matter of fact, one of the hottest IPOs of this bubble. And I'd love to hear your opinion. What do you think will happen with the Coinbase IPO? Will it be a hit or a bust? Obviously, the consensus is a hit. So you have to give me the reason. Post in the comments. What do you think is going to happen tomorrow? Hit or a bust? And why? And the winner will be featured in tomorrow's video, and I will give you a cookie. With that being said, that's all I got for you tonight, and I will talk to you again tomorrow.